and there'll be people joining us as we go, but good morning and welcome. So let's have a look at what's happening in the market. I'm going to run through very quickly. Australia, Sydney grew 1.1 last month, 3.8 for the quarter, and 1.2 annually. So Sydney has well and truly turned the corner with regards to their downturn and very much into a subtle incline. Melbourne still showing some deficits, but is turning the corner. 0.5% growth last month, 1.6% for the quarter, but they're still on a negative 2.3 trajectory for the 12 months. Brizzy, 1.5% up, 4.2 for the quarter, and still showing a negative 3% for the 12 months. Adelaide, 1.1, 3.4, and 2.2 for the year. Perth is leading the charge with a 0.9% growth last month, a 2.9% growth for the quarter, and a 4.5% growth in the last 12 months. So we are leading the way in Australasia with regards to growth. It's about bloody time. I know it has been a few months, that we have done this, and I think it is well welcomed, because we really haven't seen the growth that other states have had. Hobart, I'm not going to go through Darwin and Canberra. We don't have members there, but all showing negative growth rates for those who are playing at home. Combined capital cities, 1% last month, quarter 3.1%, and annually pretty much balanced. Combined regional, 0.1% growth, so pretty much level. 0.8% quarter, also just a slight rise, but still showing a negative 4% trajectory for combined regional. So on the national, Australian national, we've got 0.8% last month, 2.5% for the quarter, but still showing a very slight negative across the whole of Australia, minus 1.1, with the average home price in Australia of 732,886. So the headline is Value Index shows housing recovery gains momentum in August as national home values rise 0.8%. Before we have a look at New Zealand, let's look a little bit closer at the Australian reasons for what's going on. So housing values trending higher over the past 6 months. It's clear that the Australian housing recovery is firmly entrenched. Diversity from region to region, however, 65 or just over 3/4 recorded a rise in home values over the 3 months to August. Areas where values were down over the past 3 months are primarily regional areas, skewed towards Victoria and New South Wales and Tasmania. So those are where the negative growth rates are coming from, adding to a reasonably subtle growth for the Australian market. Let's have a look at the reasons. Although housing values are broadly rising, some headwinds remain apparent. Rising stock levels will be one of the most important factors to watch over the coming months. The past 2 months has seen subtle rise. Spring and early summer have historically been more active months for property listings. The spring selling season is likely to be more active than last year because of stock levels. The recovery trend has occurred against the backdrop of relatively thin levels of purchasing activity. Buyers continue to face hurdles in accessing the housing market, especially from credit perspective. Daniel, tell us why, not now, but when you give us your 2 bobs. Lending or borrowers with small deposits or high debt levels relative to their income has become an increasingly smaller portion of home lending. Additionally, borrowers continue to be assessed to service a new loan 3 percentage points higher than the current mortgage, demonstrating ability to repay their loans at 9%. Thank goodness I don't have a home loan. Persistently low consumer sentiment is another factor depending home buying activity. Until consumer spirits show a substantial lift, we are likely to see a material rise in active home buying. With interest rates unlikely to reduce until well into 2024, more households are likely to face mortgage stress. The most recent data has continued to show mortgage areas remain only slightly above record lows. However, the portion of borrowers failing behind their mortgage repayments is likely to rise through the second half of the year into 2024. This risk increases as more borrowers navigate the transition from low fixed home loan rates to substantial high refinanced rates. On the flip side, there is a range of tailwinds that should help offset these downside factors, which, with inflation reducing faster than forecast, cost of living pressures and becoming less significant, and the risk of higher interest rates has subsided. Unemployment is forecast to hold below average levels. Housing demand from strong population growth is set to remain a feature over the coming years. That's the Australian forecast, which I think is bloody good for you guys selling real estate in Australia. I think it's all definitely positively headed towards you guys as agents. So stock is a problem. It will always be a problem. You've got to get ahead of the game. You've got to be the active agent. You've got to be working on your pipeline. You've got to be working on your 3, 6, and 12-month stock now and all the time. So you've got to continually be prospecting while you're processing, and then you'll reap the rewards and the dividends through your pipeline. Let's have a look at Perth. Where is Perth? And then we'll have a look at New Zealand. So 877 transactions last week in little old Perth. There's only 5,175 properties for sale in Perth, frightfully low. And we also have 1,664 properties for rent in Perth, and 581 properties leased last week. So, of course, a very, very buoyant market here in Perth, Western Australia, which forms about 70% now of our membership. So just wanted to mention that. Let's go back to our NZ counterparts and see what's going on there. So for those of you who don't know, of course, New Zealand has had a very, very steep downturn over the past 12 months. But thank goodness for them, it is recovering and not, although it's not showing a positive growth rate just yet, it is definitely improved and getting to more of a balanced market. So modest drop in national property values hides emerging gains in key sub-markets. The pace of decline in New Zealand average property values continued to peter out in August as a number of key markets recorded increases. The average property is now worth $905,000 in New Zealand, which is 13.2% below the peak, or $137,000, but still 24.3% higher than March 2020 pre-COVID, which was $177,000. So there is still a bit of meat on the bone that you guys have got before you get to negative growth rates. So it's notable the mortgage rates are likely to now be close to their peak. On top of that, migration has significantly boosted property demand and labor markets remain robust. We're also now starting to see the impact of the loosening in the loan to value ratio rules from June 1st flow through to more low deposit lending for both owner, occupier, and investor, with 35 to 40% deposits, which were previously locked out. The softening foreign buyer rules could also boost demand and prices. Mr. Davison said that the fading downturn at the national level was mirrored across most of the main centres. He also noted that 2023 always had the potential to be a year of two halves. Subdued for a start, but signs of an upturn later. And this is coming to fruition. And we mentioned this, of course, to our New Zealand clients a few months ago or earlier in the year. However, the next phase of the market still looks likely to be slow and patchy rather than a rampant upturn we saw in 2021. The New Zealand market in 2021, I think, went up 39%. It was like insane. After all, the volume of sales rising from a very low base of less than 60,000 annually, and it may be quite some time until purchasing activities return to normality, which is around 90 to 95,000 per annum. So you guys have lost a third of your sales. Affordability is still challenging. Mortgage rates are set to be higher for longer, and debt to income ratio caps for mortgage lending remain on the cards for 2024. All factors which could help to contain any major market exuberance. In that environment, buyers won't feel excessive pressure to secure a deal before somebody else does, in turn keeping some kind of lid on price growth. Granted, animal spirits can drive faster growth in values than the underlying drivers would suggest is likely, but psychologically will likely have a lesser role to play when mortgage rates are 7% and those real cash outgoings to service debt each week are high. So big thanks to CoreLogic for those reports. Those are summarized, of course, but you can find the full report on our Google Drive. So if you're looking to, and you will see this report on our Google Drive as well. So if you're looking just to jot some things down so that you can have some conversations with sellers and buyers, these are just the real guts and nuts and bolts that I pull out for you guys. It's very summarized. The New Zealand market, all I will say is the worst is over. So make hay while the sun shines. Nobody wants increases like 39%. For the reason being, the downturn is too significant. Even though Melbourne and Sydney showed significant growth, they also showed quite quick and fast declines, which is not good for anyone. Luckily, Western Australia, Brisbane and Adelaide showed more modest growth through the 2021 rises and are now still performing quite well. So that's, but again, it's population dependent. And of course, so we're talking about, micro markets and macro markets and supply and demand, because that's what actually drives the market. Okay.